Welcome back to Share Navigator's Options 101. So far, we've explored what options are, their everyday applications, and how their prices are determined. Today, we're getting down to the nitty-gritty, the option contract itself.
At its core, an option is a contract. It's a legally binding agreement between two parties to facilitate a potential future transaction involving an underlying asset, like a stock. This contract specifies several key details. The underlying asset. What is the option based on? For example, Apple stock, Tesla, or a specific index. The strike price. This is the predetermined price at which the asset can be bought or sold. The expiration date. This is the date by which the option must be exercised, or it becomes worthless. What type of option? Is it a call giving the owner the right to buy, or a put option giving the owner the right to sell? Now let's talk about rights and obligations, which are critical to understanding options. When you buy an option, you pay a premium, and in return, you get a right, but not the obligation, to do something. If you buy a call option, you gain the right to buy the underlying asset at the strike price by the expiration date. You can choose to exercise this right if it's profitable, or you can let the option expire worthless. If you buy a put option, you gain the right to sell the underlying asset at the strike price by the expiration date. Again, you're not obligated to do so. On the flip side, when you sell or write an option, you receive that premium, and in return, you take on an obligation. If you sell a call option, you take on the obligation to sell the underlying asset at the strike price if the buyer chooses to exercise their right. If you sell a put option, you take on the obligation to buy the underlying asset at the strike price if the buyer chooses to exercise their right. So the buyer of an option has the flexibility of a right, while the seller of an option has the burden of an obligation. This fundamental difference in risk and reward is why understanding these roles is so important. Now let's talk about a crucial standardization in the options market: share control. When you trade options, you're not typically dealing with individual shares directly. Instead, option contracts are standardized. One standard options contract always controls 100 shares of the underlying asset. This means if you buy one call option contract on, say, XYZ stock, you gain the right to buy 100 shares of XYZ stock at the strike price. Similarly, if you buy one put option contract, you gain the right to sell 100 shares of that stock. This standardization is incredibly important because it means that even a single option contract gives you exposure to a significant number of shares, often for a much smaller upfront cost than buying 100 shares outright. It's why options can offer leverage, amplifying both potential profits and losses. Always remember to multiply your per-share calculations by 100 when dealing with option contracts. Understanding the details of an option contract, the underlying asset, strike price, expiration date, type, and especially the 100-share control is absolutely fundamental. It allows you to understand the leverage, control 100 shares with less capital. Know your role. Are you a buyer with a right or a seller with an obligation? This is crucial for managing your risk. Make informed decisions. Calculate your potential profit and loss scenarios accurately. We've covered the basics of call and put options with some everyday examples and option contracts. In the next video, we will delve deeper into the world of trading call and put options and provide you with real-world examples on option exchanges. Would you like to fast-track your learning and get daily support and follow our real-life option and futures trades? Contact us and request a free trial of our mentoring service. Visit sharenavigator.ie.